Hello and welcome to BQ Prime. A very good afternoon to all the viewers. One sector that is in focus is the cement space. In fact, a lots of upgrades, downgrades, multiple. It's a pretty mixed trend that we've been witnessing. But to discuss further as to what's in store, we have Navin Sahadeo from ICICI Securities joining in. Navin, good afternoon and welcome to the show.
Tell me.
Naveen, my first question coming to you is, are the winds blowing in favor of the cement sector right now, taking the way the demand is panning out and from a volume growth perspective?
Definitely, I think volumes are positive. That's the feedback. I think March quarter, as such, we saw record volumes.
Hmm.
Even the largest players like Ultratech said they ran like at near full capacity, especially in the month of March as such. And by and large, I think the feedback that we are getting is of that demand momentum broadly sustaining even in April and May. So as far as demand is concerned, I think there is definitely a positive trend or an indication that is continuing. And I think, let me quickly add that it shouldn't be that much of a surprise as well, given it's a pre-election year. So we've seen what has happened in the last pre-election, which is FY19. All India demand grew almost 13%. This year too, I'm pretty hopeful. It should definitely be growing at the range of 10 to 12% or even higher.
Right. So overall, that's with regards to where the volume growth goes. Now, the second important aspect that everyone wants to look at is as to how the price trend is panning out, right? Now, clearly, if you see in terms of the price trend, there are channel checks suggesting anything in that range of 5 rupees a bag to 50 rupees a bag is what they are going to push for. But how are the absorption levels in the market currently?
Uh, Let me simplify it for you. It's a repeat of FY19 for
Hmm.
sure. You will get good volumes, but no prices. So, whatever feedback you said of companies trying, they have been trying 6 months now. And for the March quarter, also the prices, as in companies' reported realizations were flat to marginal negative. And in most of the earnings calls, companies have guided for again flat to marginal decline even for the June quarter or so far into the June quarter. So prices is something that we should not expect in FY24 for sure.
Okay. And what, according to you, is the key reason for that?
It's the high competitive intensity, which we have been seeing
Hmm.
for quite some time now. So let me put it this way that even last year, when the entire fuel cost was
Hmm.
facing these unprecedented surge as a fallout of the Russia-Ukraine war,
Hmm.
even in those adverse situations, there wasn't any pricing action which the industry could demonstrate. In fact, in Q2, several companies reported very thin EBITDA margins or a decadal low EBITDA margins. Some even reported losses. What I'm trying to highlight is that even in that adverse scenario of a huge cost escalation, the industry couldn't show any pricing power, and thereafter it has only weakened further, more so in busy seasons like December or even till May, that we have seen that the demand support is good, but high competitive intensity is keeping cement prices weak or definitely not in the rising trend.
Right. Naveen, another aspect is in terms of earnings. Now, clearly, if you look at FY22 and FY23, the earnings were under pressure, but this was mainly on the back of high raw material prices. The fuel cost was higher. Uh, Even the demand that was slightly muted in the previous years actually prevented the companies from passing on the high costs as well. Now that you see the fuel cost, which has started to moderate, do you think it will start reflecting in the earnings of the cement companies once the high cost inventory actually gets mopped up? And that's something that we should be watching out for.
Sure. So let me first of all clarify that FY23 was again a very good year of demand. So we saw
Hmm.
almost 11, 12% kind of a growth. So that was by no means, I'm saying it was a moderate demand scenario. It was a healthy demand growth scenario led largely by South India as such. But we didn't see any pricing action. And as you rightly put it, cost was high, which dented margins. FY24, again, I'm like I said, it will be a repeat of very good demand. But I would like to believe that prices will continue to be weak. So even if your cost is definitely coming down and it's coming off pretty sharply, much ahead of, I think, streets expectations, but the underlying competitive intensity, I think, will not let the entire cost benefits accrue at the EBITDA level. Most of it, I think, will get passed on. So I am personally expecting on an annualized basis only a marginal sort of a improvement in EBITDA, and definitely not going back to those high levels that we see in FY20 or 21.
Right. So, Naveen, what's the kind of blended EBITDA per ton are you looking at in terms of an increase? Because the street is looking at least 150 to 200 rupees per ton increase. Do you think that is a possibility? Is that you're baking in, and what are you baking in your estimates?
So I'll have to be a little specific here. So Ultratech, for that matter, they closed the year FY23 with about approximately 1,000 rupees of EBITDA per ton. Mind you, March quarter was at 1,050. So in my view, this company could do anywhere between 1,050 to 1,100 rupees. And as you rightly put, the street estimate is more like 1,200 or 1,250 rupees. I think that should be at a risk given pricing power is not there. So we are entering now into a seasonally weak period where historically prices have tended to be weak, and this time more so. There is reason for the companies to be competitive because cost is also coming down that much. So I largely view this as a spread business, wherein if the cost is falling, companies will give that much more, like benefit or pass it on that much more to consumers for the sake of market share or to garner more volumes.
Right. Naveen, an interesting aspect that you pointed out was in terms of the competitive intensity. Does this mean that the sector will actually undergo a healthy consolidation over the coming years? Like we've seen a lot of mergers, acquisitions that continue to happen. The latest is where you have JK Cement, which has gone ahead acquired a small one, but in the eastern region. So is it that companies with higher net cash balance sheet are going to follow the inorganic route to garner market share then?
I think M&A has been happening in the sector, and it has been happening for a while now. So M&As per se, I'm saying, let's look at it this way: that despite all the M&As that has
Hmm.
happened, the top 4 or 5 players continue to, hold about 45 to 50% of the industry, while the balance 50% is with over 30, 40 players. So these M&As or talks of consolidation don't really help much
Hmm.
from a pricing perspective. In fact, I look at it in a slightly different way, that while companies are trying to, explore this route of expansion, be it any company for that matter. So whenever you acquire an asset, you have to introduce yourself, you have to relaunch yourself, operate the asset at an optimal utilization. That will in fact lead to further pricing aggression or competitive intensity for at least a couple of quarters before settling down.
Right. So if you have to look at if you have to, let's divide this between the mid cap and the small cap cement players as well as the large cap cement players. Now, if you have to look at the valuation, right, from an EV by ton, EV to ton per ton perspective, the mid caps are usually at the 35 to 40% discount to the large caps, right? Now,
Sure.
if you take that matrix into consideration and the way the market and the demand is panning out now, where are you seeing value from an investment perspective?
So we should look at consistency
Hmm.
rather than, there is a reason why, the mid caps trade at a discount. The reasons could be because of low margins that they make, and in turn, that is a low ROE that they generate. At the same time, there is also, what do you say, uh, they have to, in general, high leverage on the books as well. So all these put together leads to a low valuation for these companies. So you should look at stocks where these issues are largely addressed. So one such mid cap stock we have been pushing is JK Cement. Beautiful growth story, consistent volume visibility, best in class ROEs, and a balance sheet is also fairly comfortable, or at least have peaked out. So that is those kind of names I'm saying high ROEs and comfortable leverage are the names where we would be more comfortable.
Right. And from a capacity addition perspective, the kind of pipeline that we are staring at, how do you see it impacting the utilization levels? Because that seems to come across as a barrier as well.
So, from a utilization perspective, I don't think it's really changing or going drastically, because even for the next 2 to 3 years, I'm saying the capacity addition is going to be fairly high, that 25 to 30 million tons kind of a range each year. And mind you, Ambuja is just started. They have a plan of doubling in 5 years. So without that, also I'm saying there is enough and more capacity addition that is happening in FY 24-25, and Ambuja could add more to it later on. So from a utilization perspective, broadly, don't see much change to what they were in FY 23.
Right. So overall, Naveen, my last question coming to you is taking all the aspects into consideration. Now, let's consider mid caps, large caps, all of them. Where do you see value buying at current levels, with the valuations being absolutely intact or favorable? If you have to pick up top stocks, and what would your view be?
So frankly, I don't have a positive view on the sector, and the reason is, like you said, the valuations are high, while volumes are supportive. But in a commodity business, you need pricing power, and that is clearly at a miss. And this is like the running commentary which I just shared. But even from a medium term perspective, I believe the entry of Ambuja and the aggression that they are repeatedly, conveying, that they want to double capacity, that should keep in general the addition, and so the capacity addition and the pricing intensity high. So I don't find much value plays currently. In fact, Ultratech and these names are trading definitely high. We have a reduced recommendation on Sri, though it is one of the best managed companies, but extremely high valuation. So we have a buy only on JK Cement at this point in time. And if at all one has to look for value play, then we are recommending to play it through Grasim, because that is where we see some value coming up.
Right. So Grasim does come in as a top pick on that front. And clearly, if you see in terms of today's session of trade as well, it's clearly Ultratech, which is the top gainer today. Grasim also comes up in the top five gainers in terms of Nifty 50. Thank you, Naveen, so much for joining us on the show. A pleasure to speak to you as well and get insights in terms of what could be in store for the cement pack, though all the levers seem to be intact with the kind of announcements that have been made by the government as well in the budget. There is good amount of spending and expenditure from that end. And as Naveen was mentioning, this could be a repeat of what we saw in FY19, where we could see good volume growth, but the concern is going to be in terms of the pricing. And that's something which will not give them the edge from a margin perspective, and the kind of capacities that are coming on stream as well, that could have some bit of an impact as well from a utilization perspective. So that's the overall view that we have for all of you in terms of the cement sector as a whole, with Grasim coming out to be Naveen's top pick as well so far. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned.